We had a weak Facebook earnings report last night, and the day before a weak one from Zynga, which makes games that people play on Facebook. Between the two, Facebook stock is down about 22%. It's about $14 billion. It's 40% below the IPO price. What's making investors run, Rob?
Well, the problem is they don't believe that Facebook is going to be that profitable, as profitable as they thought. The problem is, of course, that they went public at an absurd multiple.
Right.
They were thinking that it was going to be the biggest company on earth, and it doesn't seem to be working out that way.
They also kind of went public, and we pointed this out at the time, when they were already quite mature, and people valued them like they were going to grow.
Exactly.
Gangbusters.
And the problem, of course, is that people are looking at Facebook on their cell phones, and advertisers haven't quite figured that out yet, and so they're not actually getting that much revenue from that.
But advertisers surely will figure that out at some point. So
yeah, they will, but currently they aren't. That's why Facebook, their profits went up only about 8% year on year, which is shockingly bad for a company that's supposed to be the hottest thing in tech.
Now, revenue went up a bit faster. So one of the factors at work here is they're spending money to try and generate more revenue. Does that seem to be working?
Well, the problem, of course, is we don't know. They're investing because they're saying, in a couple of years it's going to pay off, and maybe it will.
Right.
Amazon, for instance, has seen, it's invested for the past 15 years or so, and it's generated a lot. It's generated a lot of potential over the years, and they keep on doing that. But the problem is investors seem to believe Amazon, but they're a little bit skeptical about Facebook.
But if I look at some of the other IPOs that have come in the last year and a half or so in tech, they were all being valued on what they might earn in 2014, 2015, which even this year looks a bit silly. But last year especially, I remember bankers saying that's what investors are looking for. It's 3 or 4 years down the line when they think the earnings will get there. And you're saying that Facebook might get there in 2 or 3 years. So what's happened with it? Why have they suddenly decided that time frame is no longer acceptable?
Well, they've seen companies like Facebook do acquisitions such as Instagram. They paid $1 billion, and then they started to think, well, hold on, they could have built that themselves,
right?
Or and so should have built
or should have built themselves,
or at least not spend that kind of money on it.
And so you have to, when they do that, you have to wonder, okay, well, if they're worried about it and they're willing to spend $1 billion on buying this small startup company, are we actually sure that these profits are going to be there in 2 years?
And also, if you look at the book of charts on Facebook, if you like, you can see users tailing off a little, plateauing out a little bit. Costs, revenue, I should say, per user are not going up much anywhere. So it's like it's not exploding like it should be.
Yeah, the problem is, of course, they went public saying it's going to be a great company, and they're still saying
it already was.
It's like it'll be the company of the future and always will be.
Whereas Amazon was down 91% year on year or something. Profit. And they're spending to invest again. Investors believe them more because they have a more tangible business?
Well, yeah, exactly. They're buying warehouses, and they're actually seeing things like the gross margin go up. So Amazon could tail off their investment tomorrow. Facebook, could they? Probably not.
Okay, we'll leave it there. That's Facebook, that's Amazon, and we'll have more breaking views next week.